Welcome to the world of investment, where opportunities and risks intertwine. Let's demystify the landscape. Stocks, the ownership in companies, offer growth and dividends, but come with higher risks. Bonds or debt securities provide periodic interest and are generally lower risk, preserving capital. Mutual funds pool investments, offering diversification and professional management, while index funds track market indices, providing broad market exposure at a low cost. Together, they form the building blocks of a diversified portfolio. Balance your assets to align with your risk tolerance and goals. And remember, wise investment is not just about growth, but also about understanding and managing risks. The path to financial enlightenment awaits you. Lynette, I want you to kick us off. What was your first investment and why did you choose it?
Oh, that's a good question. You're taking me back to way back in the day. You know what? If I'm honest, I think that my first investment was some company stock when I worked for Dow Jones. And I was, kind of a cub financial reporter. And I was covering Wall Street. I was writing about corporate finance and investment banking. And this was the 90s. I shouldn't date myself, but but that was the very first one. And I don't think, to be honest, I wouldn't recommend that people buy their own individual company stock as a first. It's obviously an entree if people have never done it before. But I'm much more of a fan of funds as opposed to individual stocks. Plus, when you kind of double up and buy your own company stock, I think there's a twofold risk factor. If the company stock doesn't do as well, and potentially you could get laid off, which actually, as it turned out, 10 years later did happen to me. So, but my own company that I was working for at the time, my employer, that was the first individual stock that I bought.
Michael, we're going to get into your risk on, risk off approach to investing, but I wanted to ask you, how do you evaluate the risk associated with different asset classes, and how should people approach that?
So, traditional finance argues that risk is volatility, which I don't necessarily buy that argument. I think volatility is more a reflection of doubt. But the real risk that matters for any investor is the risk of ruin, right? In other words, something that you can't get out of because the loss is so severe that it becomes nearly impossible to crawl out of that drawdown. So I think from that perspective, one can look at different asset classes and assess what's the risk of ruin, right? What's the risk of ruin in bonds? Probably pretty low. What's the risk of ruin in individual stocks? Could be conceivably pretty high. Survivorship bias is a legitimate thing when it comes to the stock market. What's the risk of ruin with an index fund? Probably not so much, although, as we've seen with index strategies outside the US, you can be ruined by not going anywhere, right? Like we've seen with European equities and emerging market equities. But I think it's more about sort of the risk of permanent loss of capital, because as long as you have time on your side, you can crawl out of whatever, hole you're in.
Roger, you work with a lot of retirees as the retirement answer man. Can you speak to risk reward and how retirees tend to get things right, or maybe things that they're doing wrong?
Well, when you're dealing with retirees, you're at the distribution phase of life, right? And most often we think of investing fundamentals as accumulating wealth, which is something that people near retirement, if they're in the position to be able to retire, probably have done pretty well, which is embracing that volatility that Michael talked about and continuing to contribute. When you get to retirement, I think the number one framework that I see that is incorrect is when we start talking about withdrawal rates and 4% rules, which is essentially trying to duct tape on a withdrawal strategy to an investment strategy that really is meant for accumulation. So a lot of what we work to help people not just have a feasible retirement, but to make it resilient, is to deal with the time frame issue that Michael mentioned, which is when you're retired, you have different time frames for your money. So we believe that you don't just have an allocation, you have multiple allocations based on the purpose of the money over certain time frames.
Cool. I want to show the segment 2 video.